Here's a brutal truth that will save your trading account. The biggest market moves happen when you risk almost nothing, not when you bet everything. While amateurs chase breakouts with wide stops and pray for luck, professionals position themselves at pivotal points where risk is surgical and reward is massive. This isn't motivational speaking. This is mathematical reality. You think you're missing out by not trading every setup. The reality? You're missing out by risking too much on mediocre setups that drain your capital one wide stop at a time. Jesse Livermore made his fortune not by being right more often, but by risking pennies to make dollars when he was right. His legendary profits didn't come from predicting market direction better than anyone else. They came from entering positions where his maximum loss was predetermined and minimal, while his potential gain was open-ended. He waited. He watched. Then he struck at pivotal points where the market had to declare its intentions. Consider this identity test that separates amateurs from professionals in real time. The amateur sees a stock breaking out and thinks, I need to get in now. They buy at $52 after it breaks 50. Set a stop at 48, and risk $4 per share hoping for a $6 move. Their math is simple. Risk 4 to make 6. That's a 1.5 to 1 reward ratio, which means they need to be right 40% of the time just to break even after commissions and slippage. The professional waited at 49.50, risked 50 cents per share, and caught the same $6 move with 1.2 to 1 reward ratio. Same stock, same time frame, same ultimate destination. Completely different outcomes based on entry timing and risk management discipline. With 1.2 to 1 odds, they only need to be right 8% of the time to break even. That's not just better odds, that's a completely different game where mathematics work in your favor. The difference? One trades emotions and reacts to price movement. The other trades confirmation at predetermined risk levels and responds to market structure. The amateur is driven by fear of missing out and enters when the move is obvious to everyone. The professional is driven by mathematical edge and enters when risk is minimal but the setup is still forming. This distinction determines whether you compound for 10 years or churn for 10 months. Here's my promise. Master 3 simple rules: pivotal points, proof, and pyramiding. And you can ride 20% moves while risking 2%, not because you're psychic, but because you enter where your stop loss is obvious and tight. The 1-3-5 sizing system lets you scale winners without increasing dollar risk. You build positions as the market confirms your thesis, not through wishful thinking and oversized initial bets. Pivotal points force the market to reveal intent. These are weekly levels the tape has respected multiple times. Proof comes from volume and time confirmation before you commit capital. Pyramiding means adding to strength, never to hope. Each component works together to create asymmetric risk-reward opportunities that compound over time. Let me share a mini-story that illustrates this principle in action. A trader I coached spotted momentum in a biotech stock. Instead of waiting for confirmation, he chased it 5% above its pivot point. He didn't want to miss the move. His stop sat miles below real structure to avoid normal volatility. Within hours, he got stopped out on completely normal price action. Then he watched helplessly as the stock ran 30% over 2 weeks without him. Meanwhile, another trader marked the same pivot point weeks earlier. When the stock returned to test that level, he entered with 1% account risk. His stop sat just below the pivot where it belonged structurally. When the stock pulled back to retest the breakout, he added to his position. When it consolidated and broke higher again, he added once more. Final result, he captured 85% of that 30% move with surgical risk management. Same chart, same opportunity, different identities. One traded impulse and paid tuition. The other traded process and got paid by the market. The professional understood that confirmation is cheaper than prediction. Waiting for proof costs a few cents in entry price but saves you from countless false signals and whipsaws. 3 maxims will anchor this new mindset. Small risk lives at the pivot. The best entries occur where your stop loss is obvious and tight. Confirmation is cheaper than prediction. Waiting for market validation saves more than it costs. Size is earned, not hoped for. You build larger positions through systematic scaling, not gambling. The stakes couldn't be higher for your trading future. If you cut every loss at 1R and press only confirmed winners, You can be wrong 60% of the time and still compound wealth consistently. Lose 1 hour 6 times. Win 4 times at 3 to 5 hour because you pyramided correctly. Net positive. The curve isn't smooth, but the edge is real. Your protection is the small, predefined loss. Your weapon is the large, structured gain. This approach feels counterintuitive because doing nothing is often the best trade. Most days you will wait. You will mark levels, measure risk boxes, and let the crowd exhaust itself. Patience isn't passive, waiting is a position. Professionals don't idle. They prepare. They script the entry, stop, position size, and adds before the first share is bought. Before we continue, examine your last 10 trades. How many started at pivotal points with clear invalidation levels? How many had pre-calculated position size tied to fixed account risk? If that count is low, you're trading identity, not process. Professionals decide who they are first, then trade accordingly. Next, I'll show you exactly where these low-risk, high-reward pivots hide in market structure, and how to identify them with surgical precision before the crowd notices they exist. You're either early and bleeding from wide stops, or late and chasing with terrible risk-reward. This timing dilemma destroys more accounts than any other single mistake because it forces you into positions where mathematics work against you. The solution is Livermore's pivotal point, the exact price where the market must declare its intentions. These aren't arbitrary lines drawn by hope. They're structural battlegrounds where supply and demand have fought multiple times, creating zones where risk can be defined surgically. Think of a stock consolidating between $45 and $50 for months. The amateur sees opportunity everywhere and buys the first bounce off 45, sets a stop at 43, risking $2 for a $5 potential move to 55. Looks reasonable until reality strikes. False breakouts shake him out twice on normal volatility. He's down $4 before the real move begins. His crime wasn't being wrong about direction, it was trading away from the pivotal point where risk could be controlled. The professional marks the same chart differently. He draws a risk box with the pivot at $50, proven resistance tested 4 times over 6 months. His stop sits at $48.50, the last meaningful swing low before current consolidation. His risk, $1.50. Same $5 target. The mathematics transformed from 2.5 to 1 reward ratio to 3.33 to 1. More importantly, his stop makes structural sense. If the stock can't hold above the last swing low after breaking resistance, the breakout has failed definitively. Here's your 5-step protocol for finding pivotal points with mechanical precision. First, identify weekly levels. The tape has respected 3 or more times. Support becomes resistance when broken from above. Resistance becomes support when broken from below. These role reversals create the most reliable pivots because they represent institutional memory. Big money remembers these levels and acts accordingly. Second, build your risk box from the pivot to the last meaningful opposite swing. If you're buying a breakout above $50 resistance, your stop belongs near the last significant low before the current consolidation attempt. Use 0.8 to 1.2 times average true range as a sanity check. If your risk box is much wider than recent volatility, you're measuring incorrectly or the setup isn't valid. Third, pre-size your position before emotion enters the equation. Risk 0.5 to 1% of your equity per trade. Your position size equals your account risk divided by box width. $100,000 account risking 1% means 1,000 maximum loss. If your risk box is $2 wide, you buy 500 shares. No more. No exceptions. No adjustments based on confidence levels. Fourth, your entry trigger is the first close above the pivot for longs, but only after price holds above that level for at least 20 minutes intraday. This time filter eliminates false breakouts that spike through levels and immediately reverse. Patience here saves you from countless whipsaws that look obvious in hindsight, but felt compelling in real time. Fifth, place your stop just inside the risk box on the far side. Make it a hard stop. Server side, not mental. Mental stops become mental suggestions when you're watching real money fluctuate. The server doesn't have emotions, mortgage payments, or opinions about what should happen next. It executes your predetermined risk management without negotiation. Let me illustrate with earnings season reality. A biotech stock gaps to $52 at the open, blasting through the $50 pivot. The amateur sees the gap and buys the open at $52.10, figuring he'll ride momentum. The professional marks the same gap but waits. By noon, the gap fades to $50.80 as early buyers take profits and shorts probe weakness. Then, at 2 p.m., volume surges on a green candle closing at $51.20. The stock holds above $50 for 45 consecutive minutes despite multiple tests. The professional enters at $51.25 with his stop at $48.50. Same setup the amateur tried to trade, but with completely different risk parameters and confirmation requirements. The amateur risked $2.60 per share, hoping the gap would stick. The professional risked $2.75 per share, knowing the pivot had been reclaimed with volume and time confirmation. Here's your critical pattern interrupt. If the risk box is wider than 1.5% of the stock price, pass immediately. Wide boxes equal coin flips. A $50 stock with a 75-cent risk box offers surgical precision. The same stock with a $4 risk box offers gambling odds. The market is telling you the setup isn't clean enough to trade with confidence. Two maxims will anchor this concept permanently. If the stop is fuzzy, the setup is fiction. Clear invalidation levels are non-negotiable. If you can't point to an obvious place where you're wrong, you shouldn't be in the trade. Tight risk at pivots beats clever analysis away from them. Better to take a simple trade at the right level than a complex trade at the wrong level. This creates the fundamental identity contrast. Amateurs draw trend lines, channels, and patterns that look impressive but offer no clear risk management. Professionals draw risk boxes that define exactly where they're wrong and exactly how much they'll lose if they're wrong. One approach is artistic. The other is mathematical. The pivot gives you entry location, but identifying pivotal points is only half the battle. How do you filter the 50% of breakouts that fail immediately after you enter? Next, I'll show you the proof system, the tape confirmation that separates legitimate signals from market noise. Fake breakouts are the silent assassins of trading accounts. Price pops through your carefully marked pivot. You enter with conviction. Then it snaps back like a rubber band, triggering your stop before resuming the original direction without you. This scenario repeats until you either abandon breakouts entirely or develop systematic confirmation protocols. The solution isn't avoiding breakouts, it's paying for proof. Confirmation transforms maybes into high-probability yeses, turning speculation into calculated positioning. The amateur sees opportunity everywhere and acts on impulse. The professional sees the same opportunities but demands evidence before committing capital. This distinction determines whether you compound wealth or donate tuition to smarter money. Proof costs pennies. Ignoring proof costs accounts. The tape will whisper institutional intentions before it shouts them to the crowd, and your job is measuring those whispers through systematic filters. Consider this daily scenario playing across thousands of charts. A biotech stock breaks weekly resistance at $35 after months of consolidation. The amateur sees the break and buys immediately at $35.05. Convinced he's catching lightning in a bottle, his logic seems bulletproof. Resistance broken, uptrend resuming. Time to participate. 15 minutes later, reality strikes with a red candle back to $34.20. His stop triggers. He watches in frustration as the stock consolidates 2 hours, then explodes higher on genuine institutional buying. The professional marked the same 35 level but applied the 20225 confirmation system before risking capital. 20-minute hold above pivot. 2 times average volume on the breakout thrust. Close in top 25% of the bar's range. The initial break failed all 3 tests. No sustained hold, price reversed in 15 minutes. Volume registered only 1.3 times average, below the 1.8 minimum threshold. The bar closed in the bottom third of its range, showing sellers overwhelmed buyers after the opening thrust. 2 hours later, the stock retested 35. This time, volume surged to 3 times the 20-period average as institutional buyers stepped in aggressively. Price held above 35 for 35 consecutive minutes, despite multiple seller tests. The breakout bar closed at 35.80. firmly in the top quartile of its range. All confirmation criteria satisfied. The professional entered at $35.85. Next session. Gap opening to $38. Same setup, different standards, opposite outcomes. Here's your complete 20225 protocol for separating signal from noise. The time test requires price holding above or below the pivot for minimum 20 minutes intraday, or printing a 4-hour close beyond the level. This eliminates spike reversals and tests whether buyers can maintain control after initial thrust. Quick reversals indicate weak hands or stop running, not genuine institutional interest. Time acceptance proves sponsorship exists at new price levels. The volume test demands breakout bars showing 1.8 to 2.5 times 20-period average volume. Volume validates price movement because retail traders cannot sustain institutional size participation. Without volume expansion, breakouts often fail, as they lack smart money confirmation. Elevated volume is the footprint of institutions entering or exiting meaningful positions. One heavy thrust bar with proper volume proves participation beyond retail speculation. The structure test requires bars closing in top 25% of range for longs, bottom 25% for shorts. This confirms buyers maintained control throughout the entire session, not just the opening surge. Bars that open strong but close weak show sellers absorbed buying pressure and regained control. Strong closes indicate sustained demand at higher prices, proving institutional accumulation continues. Add context checks examining sector and index alignment to avoid major divergences. Individual stocks swimming against sector or market currents face additional headwinds that overwhelm otherwise valid technical setups. When broader markets or relevant sectors decline sharply, even perfect breakouts often fail, as macro selling pressure dominates micro-technical factors. You want current beneath your sail, not fighting against prevailing winds. Your execution filter requires bid-ask spreads under 0.12% of stock price, avoiding illiquid traps where small orders create false movements. Wide spreads indicate thin markets where slippage erodes edge over time. Tight spreads ensure entries and exits occur near displayed prices without significant transaction costs, destroying mathematical advantages. The scoring system requires 3 of 4 primary tests: time, volume, structure, context, triggering entry. Fewer than 3 means waiting for next setup. This removes emotional decision-making and creates consistent selection standards. You either have confirmation or you don't. No gray areas, no exceptions based on gut feelings or market excitement. Here's your crucial pattern interrupt. Yes, you'll pay up a few cents for confirmation compared to entering on initial breaks. That premium feels expensive momentarily but costs infinitely less than tuition extracted by false breakouts. The amateur saves 30 cents per share on entry and loses $2 on the stop. The professional pays 30 cents more for entry and captures entire moves because he entered confirmed signals instead of potential signals. The mathematical edge compels adoption when you examine statistics. Unconfirmed breakouts fail approximately 60% of the time, meaning you fight uphill odds from entry. Confirmed breaks using 20225 fail only 25% of the time, improving win rates by 35 percentage points. You're buying dramatic probability improvement for 2 to 3% higher entry prices. This creates substantial long-term edge when compounded over dozens of trades. 2 maxims anchor this confirmation mindset permanently. Confirmation is the cheapest insurance you can buy. Small premiums for validated signals prevent large losses from false signals. The tape never lies, but it whispers before it shouts. Volume and price action reveal institutional intentions before they become obvious to broader markets. This establishes fundamental identity contrast. Amateurs need to be first, driven by fear of missing moves. Professionals need to be right, prioritizing high-probability entries over perfect entry prices. With proof confirmed through systematic filtering, you have green lights for entry. But how do you scale into meaningful size without ballooning risk as positions move favorably? You nail the entry perfectly. Stock moves 10% your way within days. Then paralysis strikes. Take profits and guarantee a win, but miss the potentially massive move, or hold everything and risk watching gains evaporate on the next pullback. This dilemma destroys more profitable trades than losses ever could because fear of giving back paper profits creates premature exits from winning positions. The amateur faces an impossible choice because he entered with full size immediately, creating binary thinking that forces all or nothing decisions. Livermore's solution eliminates this emotional torture through systematic scaling with the 1-3-5 pyramid protocol. The pyramid isn't averaging up randomly or hoping your way into bigger size. It's a mechanical protocol that forces patience, confirmation, and precise stop placement while keeping total dollar risk anchored to your original decision. The goal is asymmetric expansion of winning positions while keeping downside capped at your initial risk amount. Amateurs fantasize about catching entire moves with full size from the start. Professionals build size as the market pays them to hold. That shift from prediction to confirmation separates gamblers from operators. Here's your complete pyramid protocol that transforms small initial bets into fortune-building positions. Your initial position represents 1 unit, entered with 0.5 to 1% account risk when your 20225 confirmation triggers entry at the pivotal point. This conservative sizing protects against being wrong while providing meaningful participation when you're right. The goal isn't maximizing initial position size, it's surviving to scale when the market proves your thesis correct through continued strength. Your first edition scales to 3 total units when specific conditions align perfectly. The stock must pull back toward the broken pivot level, hold above it despite testing, then make fresh highs with volume exceeding 1.5 times average. This pullback and breakout sequence proves institutional support exists at the new level, and accumulation continues on strength. Add 0.75% additional account risk at this confirmation point, and immediately move your stop to break even on the entire position. You've now eliminated downside risk while expanding your upside exposure. This psychological shift is monumental. You're playing with house money. Your second edition scales to 5 total units after the next consolidation phase lasting 3 or more bars, followed by fresh breakout with full 20225 confirmation. Add 0.5% additional account risk and trail your stop under the new base structure. This final edition captures the acceleration phase that often produces the largest percentage gains in strong trends. Your position peaked in size, but risk management remains dynamic and protective throughout. Let me illustrate with concrete mathematics using a $100,000 account. Stock breaks above $50 pivot with confirmation. Initial entry: 200 shares at $50 with stop at 45, risking $1,000 or 1% of account. Stock advances to 55, pulls back to 51, holds the pivot zone, then bounces to 57 on 1.8 times average volume. This triggers your first edition signal. Add 150 shares at $52, risking an additional $750. Your new totals: 350 shares with average cost of $50.86. Immediately move your composite stop to $50, break even on the entire position. Your initial $1,000 risk is completely eliminated. You're now positioned to capture further upside with 0 downside risk to your original capital. The stock consolidates between $56 and $58 over 4 sessions, forming a tight base with decreasing volatility. Fresh breakout occurs at $60 with proper volume and time confirmation. This triggers your second edition. Add 100 shares at $58, risking $500 additional dollars. Final position: 450 shares with average cost of $52.44. Trail your stop to $55 under the new base structure. Run the mathematics forward to see the pyramid's power. Total capital deployed: $23,600. If the campaign reaches a $70 target, your profit equals $7,900. Maximum dollar risk at any decision point never exceeded the initial $1,000 because once you moved stops to break even, all additions were protected by structure rather than hope. That represents a 790% return on risk, achieved without oversized initial bets or reckless exposure. Here's your critical pattern interrupt that prevents costly mistakes. Never add to losing positions under any circumstances. Never add unless previous positions show profit of at least 0.5R, where R represents your original per share risk. This rule eliminates averaging down, which transforms small losses into account-threatening disasters. You only scale when the market pays you to hold existing positions, proving your analysis was correct through price action. 4 scaling rules ensure systematic execution without emotional interference. Each addition must be smaller than the previous one, creating diminishing position sizes as trends mature and risk increases with extended moves. Each addition requires its own confirmation signal through volume and price action, no exceptions based on optimism or momentum. Stop losses move up with structural support but never move down, protecting accumulated gains against normal volatility. If average true range expands 40% or more, pause additions until volatility normalizes. Avoiding scaling during chaotic market periods. 3 maxims anchor this scaling mindset permanently in your trading psychology. Press the bet the market is paying you to hold. Increase size only when current positions are profitable, proving market agreement with your thesis. Add to strength, never to hope. Scale into momentum and confirmation, not into wishful thinking about oversold bounces or support levels. Size is earned through proof, not faith. Larger positions must be justified by objective market behavior, not confidence levels or gut feelings about direction. This creates the fundamental identity contrast between amateur and professional position management approaches. Amateurs add to positions to relieve fear of missing moves or to average down losing trades, driven by emotions rather than evidence. Professionals add to positions to confirm strength and capitalize on proven market direction, scaling systematically as probabilities increase rather than decrease. You've systematically built your position as the market confirmed your thesis through continued strength and structural support. Now comes arguably the most challenging aspect of profitable trading: sitting tight while winners run, and knowing when to exit without giving back hard-earned gains to inevitable corrections. You've pyramided into a winner, up 40% on your position. The numbers look beautiful on your screen, but psychological warfare has begun. Fear whispers, take profits now before they disappear. Greed screams, hold for more. This could be the big one. Both emotions destroy wealth systematically because they force decisions based on internal feelings rather than external market structure. The amateur alternates between these extremes, sometimes selling winners too early, sometimes holding too long and watching gains evaporate. Both mistakes stem from the same root cause: exiting on emotion rather than evidence. Livermore's solution cuts through this psychological chaos with mechanical precision. Exit on structure, not emotion. Your exit decisions must be predetermined and systematic, based on what the market tells you through price action and volume, not what your account balance makes you feel. This approach requires developing exit protocols before you enter trades, removing real-time emotional interference from critical decisions that determine whether small winners become life-changing profits. Here's your complete exit hierarchy protocol that transforms emotional guesswork into systematic profit capture. Your time stop triggers if positions show no progress of at least 0.5 within 5 sessions post-entry. Exit at break-even or maximum 0.3 loss. This prevents dead money situations where capital sits idle in non-performing positions while better opportunities pass. Time stops acknowledge that markets move in waves, and positions that don't participate in favorable moves within reasonable timeframes probably won't participate at all. Your partial profit protocol scales out 25% at plus 2R, another 25% at plus 4R, keeping your core 50% for potential big moves. This systematic reduction locks in meaningful profits while maintaining exposure to asymmetric upside. The mathematics work beautifully. If your remaining position gets stopped at break-even, you still capture 1.5 R profit from the partials. If it continues higher, you participate in the acceleration phase where the range-and-fighted largest gains typically occur. Your structural trailing stop follows the last daily higher low for swing trades or 3-bar pivots for intraday positions. Exit only on closes below these levels, ignoring intrabar wicks that often represent stop hunting or normal volatility rather than genuine trend changes. This approach lets you ride through normal pullbacks while protecting against structural breakdowns that signal trend exhaustion or reversal. Your anomaly exit triggers when range expansion exceeds 2.5 times average true range against your position without supportive news or sector strength. Exit 50% immediately and tighten stops on the remainder. Unusual volatility often precedes major reversals, and protecting capital during these periods preserves gains for redeployment in better opportunities. Consider this real scenario that illustrates the power of systematic exits over emotional decision-making. Your pyramided position averages $52 and now trades at 68, showing 30% unrealized gains. One red day drives price to 65, triggering fear throughout the amateur trading community. The amateur sees $3 of paper profits disappear and panics out, locking in a decent but incomplete victory. He captured most of the move, but missed the acceleration phase that often produces the largest gains. The professional marked his trailing stop at $62, the last daily higher low established during the recent uptrend. The pullback to 63 tested but held this structural support level, confirming continued institutional sponsorship. Price recovered to 74 over subsequent sessions as the trend resumed with renewed strength. The professional's trailing stop moved higher to 68 as new structural support formed. Final exit occurred at 72, when daily structure finally broke on a close below the trailing level. Same position, same market conditions, dramatically different outcomes. The amateur captured a 25% gain through emotional exit timing. The professional captured a 38% gain through systematic structure-based exits. Over dozens of similar trades, this difference compounds into the gap between modest success and generational wealth building. The professional's edge wasn't superior market prediction, it was superior exit discipline. Livermore's most quoted lesson applies directly here. It was never my thinking that made me big money. It was my sitting. But sitting requires rules that override natural human tendencies to act prematurely. Without systematic exit protocols, patience becomes paralysis, and discipline becomes hope. The market rewards patient capital, but only when that patience operates within protective frameworks that limit downside while maximizing upside capture. Your discipline framework must include 4 non-negotiable elements. Pre-written exit plans before entry eliminate real-time emotional interference with critical decisions. Mechanical execution of stops and targets removes discretionary judgment that often favors immediate gratification over long-term optimization. No gut feeling overrides of systematic rules, regardless of confidence levels or market opinions. Position size reduction when uncertain rather than complete abandonment. Maintaining some exposure while reducing risk. Here's your crucial pattern interrupt for managing uncertainty. When in doubt, reduce size rather than abandoning standards. Better to hold 25% of a winner than 0% because you couldn't handle normal volatility. Partial exits provide psychological relief while maintaining upside participation. This approach acknowledges human nature while protecting mathematical edge over time. Your identity is the rules you obey when money is on the line, not the emotions you feel when watching numbers fluctuate. 3 maxims anchor professional exit psychology permanently. Your first loss is your best loss, but your first profit isn't your best profit. Cut losses quickly, but let winners run through systematic trailing rather than premature profit-taking. The market pays for patience, not predictions. Extended holding periods capture the majority of significant moves, while quick scalping captures minor fluctuations. Exit rules save you from yourself. Systematic protocols prevent emotional decisions that consistently underperform mechanical approaches. This establishes the final identity contrast between amateur and professional approaches. Amateurs exit on emotion, driven by fear of loss or greed for more, creating inconsistent results that depend on psychological state rather than market behavior. Professionals exit on evidence, following predetermined structural levels that reflect actual supply and demand dynamics, rather than internal feelings about paper profits. The complete system integration stands before you. Enter at pivots with proof, pyramid with confirmation, exit on structure. This systematic approach enables capturing 50% moves while risking 2%. Transforming trading from emotional gambling into mathematical edge execution. You've built the position, now comes the hardest part. Psychological mastery that ensures consistent execution when real money tests your discipline. The brutal truth bears repeating one final time. We've dissected the complete mechanical system, pivotal points where risk meets opportunity, proof from the tape through 20225 confirmation, systematic pyramiding with 1-3-5 scaling, and structure-based exits that capture big moves. You understand every protocol, every calculation, every decision tree, yet 90% of traders who master these exact mechanics will still fail catastrophically. Not because they lack technical knowledge, but because they cannot execute consistently when real money tests their psychological limits. The final piece, separating profitable traders from the majority, isn't technical, it's psychological mastery that transforms understanding into unshakable discipline. Jesse Livermore's greatest lesson emerges not from his legendary million-dollar campaigns, but from his spectacular bankruptcies that destroyed fortunes multiple times throughout his career. His financial ruin never resulted from poor market analysis or flawed technical systems. Livermore possessed superior tape-reading abilities and understood market psychology better than virtually anyone of his generation. His destruction came from emotional trading, revenge trades after crushing losses, overconfidence after spectacular wins, and most devastatingly, abandoning his proven systematic approach under psychological pressure when the market tested his resolve. This cautionary tale repeats endlessly across markets and generations because human psychology remains constant while market conditions evolve. The market doesn't care about your mortgage payment, your ego, your need to prove intelligence, or your fear of appearing foolish. It responds exclusively to disciplined execution of mathematical edges over extended periods. Your emotions about individual trades are completely irrelevant to market outcomes. The market rewards consistent application of proven methodologies, not brilliant insights or passionate convictions about particular positions. Your integration protocol transforms mechanical understanding into executable discipline through 4 systematic approaches that address specific psychological vulnerabilities. Your trade journal becomes your most valuable learning tool, logging every setup identification, entry reasoning, confirmation signals received, position sizing calculations, pyramid additions, exit reasoning, and emotional state during execution. This isn't administrative busy work, it's data collection revealing the gap between intended execution and actual performance when money creates psychological pressure. Review your journal monthly, ranking setups by actual expectancy rather than perceived quality. Most traders discover significant disconnects between planned trades and executed trades when fear and greed influence real-time decisions. The journal exposes these patterns objectively, allowing systematic improvement rather than emotional self-criticism. Did you consistently abandon 2-0-2-2-5 confirmation during volatile periods? Did you oversized positions during confident streaks? The data reveals truth that feelings obscure. Your position sizing calculator eliminates eyeball estimates that consistently betray systematic risk management during emotional periods. The formula remains non-negotiable. Account risk percentage divided by stop distance equals position size. A $100,000 account risking 1% means exactly $1,000 maximum loss. If your risk box measures $2 per share, you purchase exactly 500 shares. No adjustments based on confidence levels, no modifications during busy periods, no exceptions during obvious setups. Mathematical precision prevents emotional position sizing that destroys accounts when inevitable. Losing streaks compound oversized losses exponentially. Your setup patience protocol demands waiting exclusively for A-plus opportunities that satisfy every systematic requirement. 3 perfect trades per year consistently outperform 30 mediocre trades because premium setups offer superior risk-reward ratios with demonstrably higher probability outcomes. The amateur fears missing opportunities and trades marginal setups that drain capital through death by 1,000 cuts. The professional fears losing capital and trades only when mathematical edges align decisively. This patience feels unnatural initially but becomes comfortable as superior results compound over time. Your emotional circuit breakers trigger mandatory 48-hour trading suspensions after 3 consecutive losses or 3 consecutive wins. Losing streaks create revenge trading psychology, where you increase risk attempting to recover losses quickly, often abandoning systematic approaches that would limit damage. Winning streaks create dangerous overconfidence where you relax risk management and position sizing discipline that generated the wins originally. Both psychological states lead predictably to capital destruction. Forced breaks reset emotional equilibrium before poor decisions compound into account-threatening damage. Here's your complete system checklist that must be satisfied before entering any position. Eliminating discretionary decision-making during emotional periods when judgment becomes compromised. Pivotal point identified at weekly time frame with 3 or more historical touches confirming institutional significance. Risk box defined with width measuring between 0.8 and 1.2 times average true range maximum. Ensuring stops are tight but realistic. 20225 confirmation received through time persistence, volume expansion, and bar structure requirements validating breakout legitimacy. Positions sized meticulously for 0.5 to 1% maximum account risk with mathematical precision regardless of confidence levels. Pyramid plan prepared with specific 135 addition criteria and stop management protocols clearly defined. Exit strategy predetermined with structural trailing levels and partial profit targets eliminating real-time emotional interference. This systematic checklist becomes your trading identity. You are someone who trades exclusively when all requirements align perfectly. No exceptions, no modifications, no special circumstances override systematic requirements. You either satisfy every criterion, or you don't trade. This identity shift from opportunistic trader seeking constant action to systematic operator waiting for mathematical edges determines long-term success or failure in markets that reward patience and punish impulsiveness. Practical automation supports psychological discipline when willpower alone proves insufficient during stressful periods. Server-side stops enforce exits when attention wavers or emotions argue against systematic rules. OCO brackets automatically stage partial profits and structural trailing stops, removing real-time decision-making from profit management. Daily loss limits of 2R and weekly caps of 5R act as circuit breakers when edge degrades temporarily, forcing review mode rather than continued trading when performance deteriorates. Drawdown management becomes crucial for long-term survival because losing periods test every aspect of psychological discipline. When losing streaks arrive, contract rather than expand risk exposure. Reduce position sizing to 0.25% account risk per trade, while maintaining identical systematic rules. Regaining execution, rhythm through flawless performance at smaller stakes. Review recent trades objectively. What was actual win rate with versus without 20225 confirmation? How often did wide risk boxes correlate with stopped-out positions? Did you add to positions before achieving plus 0.5R profit on existing shares? Numbers speak louder than emotional narratives about market unfairness. Winning streaks prove more dangerous than losses because euphoria disguises rule-breaking as superior intuition. After exceptional months, you'll feel invincible and start front-running confirmation signals, widening stops to avoid normal volatility, or adding too aggressively to winning positions. Your countermeasure requires pre-written humility. When rolling 30-day returns exceed 8R, automatically reduce new trade risk to 0.5% and pause all additions until proper consolidation bases form. Never allow hot streaks to rewrite systematic playbooks that generated the profits originally. 3 final maxims anchor this psychological transformation permanently in your approach to markets and money. The market is never wrong. Your execution might be. When trades fail, examine your process rather than blaming manipulation or unfair conditions beyond your control. Discipline is the bridge between trading rules and trading profits. Understanding profitable methodologies means nothing without consistent execution over extended periods through all market conditions. Wait, watch, win. Patience during setup development, observation during confirmation phases, victory through systematic execution of proven edges. Your identity transformation represents the culmination of this entire systematic approach to catching big moves with minimal risk. You are no longer someone who trades markets actively, seeking constant action and immediate gratification through frequent position changes. You are someone who waits for markets to pay you for patience, precision, and unwavering discipline in executing systematic approaches. This shift from active trader to systematic operator changes everything about your relationship with markets, transforming them from opponents to employers who compensate consistent professional behavior. Your homework assignment reinforces this identity transformation through practical application that reveals the gap between intellectual understanding and emotional execution. Find one weekly chart displaying a clear pivotal point with proper historical significance showing at least 3 confirmed touches. Paper trade the complete system once, experiencing every phase from initial identification through final systematic exit. Feel the patience required during setup development as you wait for proper confirmation signals. Experience the discipline needed during 20225 waiting periods when price teases breakouts without volume or time confirmation. Observe your emotional responses during simulated position management and pyramiding decisions. This exercise will expose the psychological challenges of systematic execution before real money amplifies every emotional response. The patience will feel uncomfortable initially because it contradicts natural human tendencies toward immediate action and constant market participation. This discomfort signals your psychology adapting to professional methodologies that generate consistent returns through mathematical edges rather than emotional trading decisions. If you've truly mastered catching the biggest market moves with minimal risk through this systematic approach, the next lesson on reading institutional footprints will reveal exactly where these premium setups appear most frequently, providing additional edge in setup selection and timing that compounds your systematic advantages even further.